let's get a read now on one of the sectors that has been driving the market for some weeks now. That is commodities. Now, of course, the headline act being the IGO upping its takeover bid on Western Areas. We just heard from the head of Western Areas there, Dan Locher. To take us through it, we're joined by Peter O'Connor from Shaw and Partners. Peter, good afternoon to you. I don't know whether you managed to catch that interview, but where do you see the outcome of this then? Obviously, the Western Areas board recommending that shareholders approve this.
I did. Good afternoon. I heard the tail end of Dan's remarks, the CEO of Western Areas, and I was encouraged by his humility and just his mapping out the process from here. So it is still a way to go, and we've learnt from the last 2 months that a deal is not done until it's completed and shareholders have voted. So it does look, though, with this 15% bump in terms today to $3.87, which is up about 51 cents or about 173 million Australian dollars, that should get shareholders across the line. So the board have made the recommendation. And as the CEO of Western Areas said, that it's got to go through 2 court hearings, it's got to go through a scheme vote, which requires 75% approval of those shareholders that vote. So it's not there yet, but it certainly feels like this is the right price for the environment we're in. And clearly $3.36, which is the price in December last year, looked right for a normal nickel and a normal world. Things changed in March this year, so it does feel right. There's no interloper or third party obvious at this time. There's been 2 or 3 months for that to be unsurfaced. So we suspect no interloper means no pressure from another bidder. Therefore, it's just about price, and the board's agreed and approved, so it should go ahead from here.
Okay, so it looks right for Western Areas. What about IGO at this price and the potential synergies that this will bring the company?
I named it a win-win situation, and I rarely say that, but I think in this case, even though Independence Group has had to pay another $173 million, they've ultimately won. Given that change in backdrop, whilst they did describe it as not material a week ago, it has been a material change in both the nickel price, the market outlook, and potentially where supply comes from in the short term. So their background is enormous discipline in deals that they've done, most recently New Century Zinc and also Panoramic, where they walked away from potential deals after having done due diligence. And I guess the deal of the decade, this decade, is currently their deal. It's a lithium deal that they announced in December 2020. So they've got a great track record in M&A the last 2 or 3 years, and going back over the last decade, equally as good as well. So they had to bump, but I think in the circumstances it was the right thing to do to maintain this deal. They need the supply of nickel. So I think they gave a little bit to get the deal done, and I think it's a win-win for both. So look, I would concede in this case, would have been great to get it at $3.36, but with $3.87, I think they should be pretty happy with the deal that they've struck.
Peter, let's stay in that battery metal space, obviously nickel being one element there. Iluka is also in that space, and it has, it's the mineral sands miner. It's announced that it's going to spend more than $1 billion with a rare earth mineral production site there at Eneabba in Western Australia. Just talk us through what's happening.
It's a great pivot, isn't it? So they've been flagging this for about 2 years, so it's not really a surprise, but I don't think anybody really believed it because it wasn't in the share prices or valuations of most people on the buy or sell side in the market here in Australia. So again, well known, well flagged, but probably not in the share price. So this move is the biggest move that they've done business-wise. They did do another smaller pivot about a year ago with the divestment of their iron ore royalty called Deterra, which is a listed company, but this is large. This is setting them up for another business for many decades to come, and it's a completely different stream. So it doesn't impact the mineral sands business the way they've structured and financed it. It's effectively ring-fenced and won't temper their current businesses. And what I love about it is the government funding they've got. Low coupon, long duration, government backing, which is giving them the confidence to go ahead. And the deal that they struck and the prices of the commodities of rare earths that they used in that structured deal are fantastic. They're about 100% higher than they would have been a year ago. So Iluka's done a fantastic deal with the government. They've also got in place the key metrics that I look at in developing mineral products. Firstly, they've got a resource in the ground. It's real, it's tangible, it's the highest grade monazite in the world. They've now got government financing at low coupon, long duration, as I mentioned. They've got the pathway get it to the market, because we know that the EV demand is there, as Dan, the CEO of Western Areas, just mentioned. It's just a function of delivery. So for them, over the next 2 years till they start up in late 2024, it's just about delivering. And that will be hard in WA, given capex pressure and also operating cost pressure. So we'll watch that closely on a quarter-by-quarter basis. But so far, they look to have mitigated most of their obvious risks. So from here, a 2-year journey, but it looks like they've set up well.
Okay. Peter, elsewhere in the complex at the moment, that merger with BHP's petroleum assets with Woodside, that's getting close now.
What a great deal, hey? Flagged last year in August at their full-year result. They talked about the pivot into potash, their long-duration business, the unification of the company, the simplification that brought about in January this year, and now it's out of oil. This is a 60-year journey they've been on in oil. We've followed in Bass Strait and US, shale, etc., and now the divestment. And again, I don't think anybody really believed this was going to happen because it doesn't appear to be fully in the share price. Perhaps in recent weeks, maybe, but this has been talked about going back to August last year. So key drivers are May this deal will be voted on by Woodside shareholders, completion in early June, and a current price of about $6.10 Australian per share to BHP shareholders as a special dividend with franking on top of that. So it's worth about $8.50 per share. A great windfall, and when you add onto that special dividend the typical final dividend that BHP is likely to announce in August and pay in September, which the market's currently forecasting about $2.40 per share, that's an extraordinary windfall for BHP shareholders. And you have heard me say before, never buy a resource company for dividends, and you shouldn't do that. Typically it's a red flag, but this is such a one-off asset sale based situation, like when they sold their shale business in the US in 2019, and its shareholders are enjoying the benefit. That sale was $5 billion, this is $22 billion US dollars, so it's a big deal. And they take a lot of franking credits to go with that, but shareholders enjoy the benefit this time. So a good deal, and I think you'll find the simplified BHP will perform as it has over recent weeks and months.
All right, let's stick with energy, in particular coal. We know what's going on there with those sanctions. The EU now moving essentially to ban coal imports from Russia. They're attempting to do that with, we've also seen what's going on with oil and gas. But Peter, what are the implications if they do ban those Russian imports of coal? Talk us through what's going to happen with the sector, but I guess particularly for the Australian producers.
The outlook is unequivocally positive, that's the starting point, but just to fill in the details. So currently Europe imports about 120 million tonnes of thermal coal for power generation from Russia. And to put that in context, if you added Colombia, which is a key supplier to Europe, plus also South Africa, they produce about 120 million tonnes, not deliver, produce. So looking for elasticity in global supply to replace 120 million tonnes is almost impossible. So that coal trade needs to be redistributed around the world. And invariably, like when China banned BHP coal and Australian coal 2 years ago, it took about 2 years to redistribute that supply. So we should think about this being a redistribution as sanctions will allow. But that 120 million tonnes on a 900 million tonne market, that's a very, very large chunk of capacity. So it's going to take time to trigger those moves. Those moves will need to be incentivised by price, and we're starting to see that again last week, where price moved from its low of $260 US to about $291, and that's lifted the whole complex up and created a floor. So at least until we see a resolution of Russia, Ukraine and sanctions around that, price will stay higher for that period of time. That could be quarters, it could even be years, and after that it could take some time to normalise the global supply. So coal prices, which we used to think about at $50, we're now talking about numbers 200, 250. So cash flow generation is extraordinary. Free cash flow yields are in the 20-30%. So income coming back from that sector will either deliver and grow the market cap that way, or it'll look to be dividended back to shareholders. So very cash-rich sector, and it's the same story for Coronado Coal, for Whitehaven Coal, for New Hope Coal, Stanmore, and some of the juniors that are emerging as well, Bowen Coal, etc. So it's a fascinating backdrop, given everybody looks at coal as being the dirty sector to be in, but it's got this extraordinary tailwind, and that could last for some time.
Are you looking to get in now, or is it too late?
The journey's been long so far, so my answer would be it's probably getting late-ish, because back when Whitehaven Coal, as an example, was sub $2 and close to $1 per share, and you think, well, today it's $4.50, it's kind of in the price. But that backdrop I just mapped out for you, where potentially a multi-quarter or multi-year disruption to trade flow and prices staying maybe 4 or 5 times higher than normal, that would see cash flow support the sectors going forward. So I don't think it's too late. I think the easy money's been made. If you're looking at income for a fixed period of time, and don't chase dividends again, as I mentioned before in the resource sector, but income should be okay for a little while. And I don't think the share price has yet reflected the outlook. And to give you a benchmark or a line in the sand, Whitehaven today, at the current coal prices, comparing to previous cycle highs, should be trading well north of $10 per share. And that's a similar situation for its peers. So none of these sectors, be it oil, gas or coal, are trading near what they should, given previous cycles. So there's an enormous amount of headroom. whether ESG restrictions will allow that to happen in terms of investor perception, but they're still cheap. But I think that easy money's been made. So from here, it's about income, and upside will just grind higher the longer this duration continues for in this redistribution of cold flow.